Fresh from the failed float of his ResourceHouse company in Hong Kong, mining magnate Clive Palmer's hitting back at his critics, claiming he's raised the money anyway. Mr Palmer's announced an extra $1.2 billion in funding from China and says missing out on a share market listing is no big deal. Andrew Robertson reports.
The investing community is used to surprises from Clive Palmer, but few were surprised by the weekend announcement that he was abandoning the $3.4 billion listing of his ResourceHouse mining company on the Hong Kong stock market.
The fact that he's been down this path now for the fourth time is not helpful, and it's going to make it so much more difficult for him with whatever funding options he decides upon for the future of ResourceHouse.
Shortly after Gavin Wendt uttered those words, Clive Palmer sprang another surprise, an extra $1.2 billion in Chinese funding for his proposed Queensland and Western Australian coal ventures, and claims he didn't need the IPO anyway.
Yeah, it's very, very good vote of support by the Exim Bank of China and also by the Chinese government to support the project with such a large amount of money, so it's very exciting.
And Mr Palmer has hit back at people like Gavin Wendt and his many other critics, claiming they've got the ResourceHouse story wrong.
The first time we've ever gone to IPO, first time we've ever launched it, first time the prospectus has ever been approved. It's never got out 3 or 4 times. It was just people lying to the press or the press speeding up the articles.
Mr Palmer is also unapologetic for the decision to walk away from last week's planned share market listing, saying his hand was forced by factors outside his control.
What we were caught in really was the movement in global markets. There was $20 billion wiped off the Australian share market on Friday alone.
Accounting firm Ernst & Young, which did some work on the float, sympathises with that view.
Any company that's going to the market without a profit history in Hong Kong is relatively unusual. There hasn't been that many that have got up under the new listing rules yet. And so those floats will get away, but in periods of stability, whereas last week was very volatile on all world markets, and so they're going to be the first stocks that investors are going to move away from at that point in time.
Long-time resources sector watcher John Robinson doesn't quite buy that explanation, though. He believes the real reason is that the ResourceHouse float was about 30% overpriced.
I think there were just too many risks involved in the proposition, and I think that reflected obviously in the market appetite.
And John Robinson thinks there were also some unusual features in the proposal which would have left Clive Palmer with 54% of the issued capital.
ResourceHouse was in fact getting a right to mine rather than control over the resources themselves, with a fairly handsome flow of royalties back to Mr Palmer. This was a model that he's used previously. I think it was back in 2007. A similar deal was done with an entity that's now called Sino Iron.
MineLife's Gavin Wendt also disputes Clive Palmer's explanation for axing the ResourceHouse float. He points to the success of the Glencore share market listing just a few weeks ago.
If it's a sound company with sound projects and good management, then even in difficult market circumstances, investors will still put their hands up.
All eyes are now on Clive Palmer to see if the promised extra Chinese money actually arrives, and then if the China First coal projects in Queensland and Western Australia come to fruition.